Hey guys, welcome back to the YouTube channel. I'm Yaro here. Today I'm going to be talking about the crazy week that we've had in the market with the Dow Jones down as much as 7% in a single day. I think this has actually created a huge buying opportunity, and I've made some changes to the investment portfolio that I have on M1 Finance. So I've removed some plays that I think kind of speculative. I've also added a couple of companies that I think are a good long-term growth company with steady dividends and been paying out these dividends for a long time. And I've changed up the allocation percentages in this portfolio to be more balanced, and I'm going to be covering this in this video. But before I get into it, make sure you click that like button and subscribe to the channel, hit the notification bell, and I'll be posting a new video about investing every single week. Alright guys, so let's get into the new portfolio update, and I'm going to talk about the different strategy approach that I'm going to be using in this time where the market's looking like it's going to be continuously going down and correcting. I decided to invest $250 a week instead of $500 every 2 weeks into this portfolio so I could get a better average cost and I can buy more stocks as the price declines. So that's what I'm going to do from this point on. As long as the market continues to drop, you could see that there was the high point where the portfolio value was $2,065 and it dropped to $1,843, and then I put another $250 in, and that's the current value is $2,136. We're still showing gains with a percentage return of 8.66%, and I did get some more dividends paid out. Now let's get into the new positions in my portfolio that I am going to be adding. First one is SPYD. It's very similar to SPHD. It's just a different ETF that pays out quarterly dividends instead of a monthly dividend. So I decided to keep both of these in my portfolio and have both of them paying me dividends. The reason why I want to add this is because SPYD has a slightly higher dividend yield than SPHD, and if you look at here, SPYD pays a 6.47 annual yield, while SPHD pays a 5.56% annual yield. Now, I looked into the holdings of the company, and they are very similarly distributed by the sectors. If you look at real estate, financials, consumer cyclicals, it's very similar to what SPHD is doing, and it's not a big variation or a big difference in the holdings. And if you even look at the top holdings, Gilead, DLR, General Mills, Crown Cas International, these are the same holdings that SPHD has. Look, Gilead, General Mills. So I just decided to keep both of these in my portfolio, and I'm going to be continuously investing into both of them. Now the next holding I am going to be doing is Simon Property Group. It's a real estate group that owns malls, and because malls have been hit so hard, I think it's a great buy. If you look at Simon Property Group, it has an 11% dividend yield, and it's been growing consecutively for 10 years with the average growth rate of 10.68%. The payout ratio is very high, but this is a real estate group, so I would expect that payout ratio to be high. This is actually relatively conservative for a REIT. Looking at the dividend history, the group has been growing that dividend for last 10 years. This is what I really like to see. And looking at the financials, the company is very well managed. Looking at the revenues, it has been increasing since 2015, where we have the data. Every single year has been an increase in revenues, and the company has been doing very well. Also, looking at the cash flows for Simon Property Group, they actually are very well manage their cash flows with increasing cash flows from operations every single year. So the difference between cash flow and net income is net income has certain expenses that are non-cash, such as depreciation and amortization, gains and losses on investments, and other operating activities. So this is to get to the actual cash provided by operations. You gotta look at the cash flow statement. You look at the investing, what they do, and they've been acquiring real estate assets every single year, very continuously at a conservative rate. And financing activities, they have issued long-term debt and paid off some long-term debt. So this is pretty much refinancing it. So company is very well managed, has a high dividend, and has been continuously growing. So this is going to be in my portfolio. I wanted to add into the real estate sector a little more. Then I also added Altria Group, and the stock ticker is MO. So if you don't know what Altria Group does, you could read about the company profile. And manufactures and sells cigarettes, smokeless products, wine in the United States. So stuff that the consumers are going to be using, especially with the lockdown and everything. People are looking for some kind of relief, and people do smoke and people do drink. So I've looked into this company, into the financials, and I think this is a really great company also to have in your portfolio. It has been increasing its dividend for the past 50 years. So this is a dividend king. It has this title because it has been paying dividends and growing the dividend for the past 50 years. And the average 5-year growth rate, so the average rate every single year, the increase is 10.40% with a payout ratio of 78.78%. This is a little bit high, but like I said, this company seems to be pretty safe in my opinion, with the way that they have been increasing their dividend for such a long time. And the dividend yield is 8.59%. This is a really high dividend yield, and will be paid on a quarterly basis. Looking at the financials, you'll be able to see that the revenues have been increasing every single year. So that's a good sign. I think the company is going to be relevant in the future. They have about $8 billion in current assets, and their current liabilities are at $11 billion. So it's not that. I usually like to look for a company that has current assets with a ratio of at least 1. That way I know the company balance sheet is safe for at least a year, and that the company cash flow is being managed well. This is like 0.8 ratio instead of that 1 that I'm looking for, but because the company has been a dividend king, increasing their dividends, I have decided to add this to my portfolio. And it's going to be a 3% allocation. SPYD has a 7% allocation, and Simon Property Group is a 4% allocation. So those are the 3 companies I'm going to add, and I'm going to be removing Icon Enterprises and Prospect Capital Corp. The reason why I'm removing this is because they're kind of a speculative play. They had really high payouts on dividends, but I think that if I'm building this portfolio, that this is a long-term growth portfolio that's going to continue to increase their dividends, and I think these companies, their dividend safety is not as high as I would like it, and because it doesn't align with the goal of this portfolio, I am removing it. But I do see these as still very valuable, so in other investment accounts I will be able to add into it. I just don't want it in this portfolio. So yeah, and I did mention that I changed up the allocations of the portfolio. So SPHT is now 7%, SPYD is also going to be 7%. I took REM and I dropped it from 10% to 6%. That way I can also add in Simon Property Group, add in more real estate into this portfolio, and then I did more consumer goods, so I added 3% of Altria Group, and I removed Icon and Prospect Capital, so that gave me more room to allocate. So that's it. Thanks for watching, guys. I appreciate it. I hope you have a great weekend, and I'll see you guys next week with another episode.